Topic of our today's video is the 10 biggest investment mistakes to avoid while investing. Investing is essential for long-term wealth accumulation. However, simply investing is not enough. The right investment is essential. It is very easy to make mistakes that will hinder your ability to accumulate wealth in the long run. When making investment decision, one must first answer fundamental questions such as what resources should be aside to begin the journey. One must also keep the end goal in mind and above all choose the best investment option for a given period of time. With this in mind, it is very important to know that understand the common mistakes and traps the investor usually fall into in order to be able to navigate around them successfully when needed. Some of the 10 biggest investment mistakes to avoid are explained now. Number one mistake is chasing trends. This is very common, especially among the first time investors. To most, what works for Paul will work for Peter. They are guilty of assuming that since everyone is talking about something and most of the people they know are getting on board, then it is automatically mean that it is worthwhile investing opportunity. However, history has shown that trends do not necessarily lead to a successful venture. If anything, trends can be tweaked and used by con artists to lure such investors. A good example could be the Amazon web worker scandal where Kenyans lost millions of their hard-earned money by simply following the wave. When it comes to investment, throughout research and vetting is one of the non-negotiable. Mistake number two is following shady advice from social media. When we fall sick, we head to the doctor office so we can trust their qualification and judgment. However, when it comes to putting our money into an investment scheme, most tend to either go in blindly or trust strangers on social media. Most of these investment experts on social media are just salesmen trying to meet their daily quota, and you end up with as the inviting client. Some of them could also be selling the hot air. Just because they have hundreds and thousands of followers doesn't mean that they are qualified enough as an advisor when it comes to investing. One should seek an expert that are specific to their area of interest. For example, if you are looking to invest in the real estate industry, seek out leaders in the field. People with a proven track record when it comes to real estate investment as opposed to ghosts behind a keyboard that are blessed with the gift of gab. Mistake number three is not giving your investment time to grow. Most investors know that patience is one of the most important part of the process, but is also one of the most difficult skill to learn as an investor. Giving your investment the time needed to mature and start proving return maybe seems like a boring strategy, but it has a known to rake in the good return in the long run. For example, for one of the experience of the magic of compounding, time is a necessity. In investing, compounding comes about when the return on your investment also start delivering return. Think of it as an interest earning interest as a new interest also earning interest on itself month over month or year over year for many years. However, getting to the point demands patience and discipline. The most successful investors both locally and globally use both in their everyday approach for investing. Mistake number four is investing money you will need soon. Some will tell you that even tiny moves can lead to the growth when it comes to investing, and they could be right. It helps nurture a healthy financial habit. If you start small and slow, even with a small amount of cash, you are undoubtedly cultivating a habit of investing regularly. However, if you are tracked all your emergency funds and daily and keep money toward an investment that are gamble, it is no different than someone going for a big lottery win. If you get it right, your life change, but not the flip side. Pouring every day you have on an investing opportunity that stands a 50-50 chance of success is not a smart move. When you start investing money, you will soon need. Chances are that you will drain your young business investing in no time. Maybe try setting up a separate investment fund or kitty instead and grow it when you are looking into potential areas of investment. Mistake number five is having unclear investment goals. Your investment objective and goals drive your entire investment strategy. You may do not even set an objective prior to investing. This is a recipe for failure, as having a clear objective is a non-negotiable when it comes to investing. It is also important to know that I want to be rich is not an objective. Rich means different things to different people. To set a realistic objective along their lines, one need to get into the details of what being rich or wealthy means to them and create plan and how to get there. For example, do you want to enjoy a comfortable lifestyle, take 3 holidays a year, or you are looking at creating an empire of your own future generation? Once you know that what you want, and you can then steer your investment objective to reach their goal. Overall, one needs to track a step back and evaluate how their investment objective align with their horizontal time zone. Your objective need to be specific, measurable, achievable, realistic, and time bounded. In short, smart. Mistake number six is delaying investing altogether. It goes without saying that multiple streams of income are vital when it comes to wealth creating in the long run. Keeping all your cash in a bank account means that the money loses its purchasing power due to its rising rate of inflation. This is not to say that everyone is meant to go down the path of entrepreneurship, but there are other ways to invest your money, such as money market funds or even investing in a friend's business. The goal is to grow wealth in the long run, and this doesn't mean quitting your job and opening a business. Find a path that works for you and grow your money at your own pace. However, falling into a business investment in another potential revenue streams either due to some comfort derived from employment or simply fear could potentially lead to regret. A good question to ask is what happens if my current source of income stop arbitrarily? That should be a reason enough to look into investment opportunities. Mistake number 7. Not understanding the investment. You have to understand what you are getting into. It is simple as that. Investing is an effective way of making your money works for you in order to build wealth. Pouring your money into a venture you know little about can be likened to flushing into a drain. You need to understand the interactive of the business you are getting into. For example, if you looking to start a small food delivery business, you will need to know that the operation, the cost, the right suppliers, and their best alternative in case there is supply chain issues. The most preferred menu, what to do with leftover licenses, need to operate best pricing models, best marketing channels, etc. Just getting into blindly means that there is a high risk of getting stuck and falling even before the business take off. One therefore need to carry out a detailed analysis of an investment opportunities prior to engaging and funding it. Mistake number 8. Failing to diversify. There is always an element of risk when it comes to investing, which then makes the option to spread your risk a viable one. It is a proverbial putting all of your eggs in one basket scenario. By spreading your investment across a different asset, you are less likely to go under when an unforeseen investment wipes out all of your assets. Diversification is simply a way of spreading risk to counter an unexpected losses. Investment can go up and down depending upon the assets you choose and how the market is performing. There is always a natural part of investing. The potential return and the risk involved when it comes to investing change during the time of economics, political and regulatory development. For example, the government could decide to ban all kind of plastic packaging, however, does affect your business. Another example, COVID-19 strikes and all social gathering banned. This means that small pub will take major hits. Can you adjust? Do you have a fallback plan or venture? This is simple questions to ask. If you have a diversification portfolio, adjusting to such changes is easier as when one is down, the other could go up. Mistake number 9. Letting your emotions rule. When emotions take the lead in investment, logic tends to fly out of the window, thereby increasing the chance of failure. Understanding the risk associated with investment is one of the reasons why investors sometimes make questionable decisions made on emotions. There are mostly two conflicting emotions that usually end up steering our investment behavior: fear, made by risk, and greed, and made by return. These emotions usually create an illusion of control in that we end up thinking that we have a control over the market force to play and that we are cunning enough to never experience losses. For fear means that we are likely to end up going to pull the plug on any investment the moment your small troubles happen. For example, Carol's food business is going under due to COVID-19, so we fold up and close before it get hit as hard as Carol. However, had we managed to control our emotions, we could have probably looked into how to adjust our small business to go with the time, e.g., home and office deliveries. Greed, on the other hand, gives a false sense of invincibility and nothing can go wrong mentality. This led to investors into ventures building on sands. Psychologists have shown that greed is what con artists target when looking to lure unsuspecting victims. By controlling your emotions and making investment decisions on facts and hard data, you have already won, as it means that you will best equipping to handle any market shocks. Mistake number 10 is confusing good investment ideas with good marketing. It is very important to be able to distinguish between viable investment ideas and good marketing package as a viable opportunity. The thin line between the two had seen Kenyans losing their money in elaborating schemes such as shady greenhouse deals, shady land deals, and shady quail eggs phenomenon to name but a few. On paper they have good, but if you take a few minutes to look understand the hood, and you will realize that it's smoke and mirror. The opportunity to make a fortune in a short amount of time is appealing, almost irresistible. However, one need to be stingy with their money when it comes to investing. Digging deeper before putting your money into anything is the best practice. It may take some time and delays, but is always worth it. And in the end, as it means that you go into an investment opportunity with both eyes open.